Leslie Alba, why investors must rethink how they allocate capital. Celebrations to mark a new year in the Chinese lunar calendar have been understandably muted this year in the face of the recent outbreak of the coronavirus, which has resulted in widespread loss of life, shut down airports, halted trade and led to the rapid construction of new hospitals in China. The effects of the outbreak will push the country's economy into a period of slower growth, with stocks trading lower as investors seek protection. China is now the dominant exposure in some well-followed global emerging markets equity benchmarks with a weight of approximately 34%. So what does that mean for the majority of portfolios that have direct or indirect exposure to the country? And how might we make a reasonable assessment of the potential impact of the coronavirus in relation to all the other factors an investor must factor in? Will, for example, the collective impact of the outbreak, fewer flights, less trade, reduced productivity and so forth, affect a few businesses, a few industries or entire markets? Alert but unassuming. Our own answer, at this stage, is to be alert but unassuming. It should be noted there is no safe approach for investors here. For example, exiting stocks in favor of cash has its own risk, namely crystallizing any losses suffered to sentiment while almost certainly missing out on a rebound if the virus were to be contained quickly. As such, we would want to proceed by contemplating the effects of what we consider to be the most likely scenario, while taking other possible outcomes into account. Remember, this has all occurred on the back of a combination of trade wars, unrest in Hong Kong, political tension with Taiwan and the slowest economic growth in 30 years. These have all competed for attention in the minds of investors. At the same time, one of the most significant events for investors occurred far more quietly in the computers of index providers and passive fund managers, as the representation of China's A-share market quadrupled in some emerging markets indexes. This not only makes China too big to ignore for investors, but is a key consideration when investing in broad emerging markets funds that are likely to have a sizable holding in Chinese markets. Long-term lens. When viewed through a long-term valuation-driven lens, our research suggests China is one of the least attractive equity markets in either the emerging or developed world. One of the reasons for this unattractive profile is the high exposure of the Chinese market to expensive consumer discretionary and communications stocks. While such businesses have benefited from the rapid economic growth in the Chinese economy over the last 30 years, future growth now appears to be fully discounted in the price of these assets. In contrast, China has less exposure to attractive energy and matter. For more on this story, visit the news article link.